results. Moody's came out with a report and they have said that India is unlikely to reach the growth of 7% till 2017. They see progress under PM Modi, but no change in view till results are seen. Glenn Levine, senior economist and head of office at Moody's Analytics, joins us on the line from Sydney. Glenn, good having you. Thanks so much for joining in. Is this a bull case scenario, or is this a bear case scenario or a base case scenario of a 7% GDP growth until 2017?
I don't really know what the consensus estimates are or what others are saying in the wake of the election. I did note that the Prime Minister himself came out recently and said it's unlikely that the economy will be growing at 7% until 2017, which is exactly what I've said. Now, I don't know whether he's just trying to couch expectations, trying to lower expectations about the path of the economy, or whether that's genuinely what he believes. But I think that given where the economy is at the moment, the state of the business sector, the downbeat investment numbers, that is going to take a long time to turn around. And so I think 2-3 years is pretty reasonable at this point.
Glenn, your estimate of 2017 and 7%, on what has that been based? Do you expect inflation to be under check by then, or do you expect inflation to still be high?
I'd be surprised if it was still high. I think if it stays high for too much longer, the Reserve Bank will be forced to act. They have made that the clear focus of their mandate under the new RBI Governor Rajam. So I mean, we have seen the consumer price measure of inflation cool a little bit. The wholesale price ticked up a little the last couple months. I think if it stayed too high, interest rates would rise, and then I think the economy would be in real trouble, and then that would push out my 7% growth projection by another year or two.
As far as forex inflows are concerned, we've seen huge inflows coming into the economy. How much of this liquidity how much of it will add to the inflationary pressures?
Oh, that depends where the money goes, I suppose. It ought to not add too much directly to the inflation figures. I mean, we're seeing it go into portfolio investment in particular. The Sensex has been doing quite well in the last month or two. That doesn't strike me as particularly inflationary. The credit numbers are still reasonable. The credit growth, I don't think that is the main consideration. I think as your previous guest alluded, the supply side of the economy really is the problem, and that if firms aren't investing, if infrastructure projects are not being approved, then the maximum growth speed of the economy is lower than it otherwise would be, and if demand gets too strong, then inflation will rise.
Would you think that markets have run way ahead of actual fundamentals? And how much of a breather will markets give us? Will they give us a long rope? Will they kind of have faith in us for another 3 months, 6 months? Or will they kind of run out of patience?
I agree wholeheartedly with your initial assessment that markets are a little bit overcooked right now. I think what you will find is that once the reality of the new government settles in, I think once some of the excitement bordering on hysteria in the business and investment community, I think that will become superseded by the political realities that the new Prime Minister and government will have to deal with. I mean, they still only control the lower house of Parliament, and so to push through any bills of note, they're going to have to work with regional parties in particular in the upper house. And I think once that happens, then you're right, we could see sentiment and markets cool. I think they've still got 3 to 6 months, though, before we start to see signs of that.